Sports betting company Draftkings is up 138% over the past year, taking the company's market value to $23.2 billion. But Draftkings financials don't look particularly attractive. Revenue over the last 12 months grew 64% to $3.7 billion, but net income is negative $800 million and adjusted EBITDA is negative $151 million. Free cash flow is also in the red and the company reports almost $400 million in stock-based compensation. However, in DraftKings' case, negative profits are not as bad as they seem. Following the legalization of sports betting in 2018, DraftKings has been in a race to take market share. The company spends money up front to acquire customers, then drives substantial profits from those customers over time. So far, it seems to be working. In 2019, the company generated revenue of $323 million. The figure last year was more than 11 times as high, and DraftKings appears to be cementing market share. According to this report, the two largest operators are Draftkings and FanDuel, with over 60% of the market. Market share has allowed Draftkings to cut back on promotions in order to drive efficiency. Incredibly, while revenues grew 64% last year, sales and marketing costs increased by less than 2%, and management said customer acquisition costs dropped by almost a third. This operating leverage allowed DraftKings to report a huge $570 million swing in adjusted EBITDA. So it's not hard to see how DraftKings can quickly get to significant free cash flow. In fact, in the latest shareholder letter, management laid out expectations for $1.4 billion in adjusted EBITDA by 2026 and $2.1 billion by 2028. Crucially, that figure doesn't include any contribution from additional US legislation or from the $750 million acquisition of lottery provider Jackpocket. Given that states like California and Texas have not adopted online gambling, there's still clear upside to this forecast. So let's assume DraftKings hits its target by 2028, then let's include $100 million of EBITDA from Jackpocket plus $300 million from new states, and 2028 adjusted EBITDA gets to $2.5 billion. A 20 times multiple then takes the valuation to $50 billion. Even with 3% annual dilution from stock-based compensation, the annualized return works out to over 13% per year. There are risks to consider. DraftKings' target of 10% hold, which is the percentage of money that sportbooks keep for every dollar wagered, looks high and could end up reducing the lifetime value of its customers. Meanwhile, states like Illinois are hiking taxes to capture a greater share of revenue. But the biggest risk is that DraftKings needs to maintain its market share in a competitive market. Penn National tied up with ESPN last year. There's also Caesars, FanDuel and BetMGM. But if DraftKings continues to do what it's been doing, the stock price looks set to keep going higher. But these are my personal opinions, not financial advice, and I hold no position in DraftKings stock. For more investing videos, make sure to visit my website at 3minutebreakdowns.com. Thank you for watching.